Equity markets have largely looked past a variety of risks out there, but what's happening in the bond space? Joining us now to discuss, Alex Gorwitz, VP and Director for Active Fixed Income Portfolio Management at TD Asset Management. Great to have you back on the program, Alex.
Thanks, Greg. Great to be here.
We're at the halfway point of the year. We've entered the second half of the year. We have equity markets at all-time highs, no shortage of risk. The equities don't seem to mind. Do the bonds mind? What's going on bonds?
Not doing very much. Interest rates have been pretty range-bound of late, and I think there are a lot of forces that are pushing and pulling on where interest rates should go from here. So that's actually led to some surprisingly sort of calm trading days in the bond market in the last couple of weeks.
In the last couple of weeks, we don't even have to go far back to have geopolitical risk, war in the Middle East. We've had concerns over the U.S. Big Beautiful Bill, what it could mean for the economy. There's a whole bunch of things that I guess in regular times I would think the bond market would react to. What do you think is going on there that the bond market is seeing through these things?
I think each one of the things, of the factors that you've mentioned that historically could have or should have led to much bigger moves in the bond market or a clear direction being set in the bond market can actually be seen from multiple points of view. So for example, take immigration. Right? This is a relatively easy one because there's something actually easy about it when you think about the pass-through effects to the job market. But when you take immigration policy on its own, a tighter labor market should mean stickier wages. That could potentially push up on inflation. That should push up interest rates. But then longer term, a smaller labor market generally means shrinking economy in the longer run, right? So all things being equal, those two factors are sort of pushing and pulling on where interest rates should go from here. I could do the same thing with the budget bill. For example, what's being currently pushed through the House is substantially higher deficit than the initial move from the House to the Senate with the bill, and an extra $500 billion to $600 billion of debt that needs to be factored in over the long term. That should push interest rates higher. On the flip side, we're seeing a lot of commentary from the Treasury saying that they're going to fund a lot of that with Treasury bills. That doesn't mean an increase in bond supply, and then that's weighing lower on interest rates. So you see how all the different factors, all the different events and developments that you've highlighted, each one of them could be analyzed from different points of view and are having this sort of offset, almost like balanced impact on how interest rates are trading right now.
From what we keep hearing from Jerome Powell in terms of patience and this factor could be this, but this factor could be that, slowing economy, maybe higher inflation. They're on pause because they really don't know what to do in this situation.
Correct.
If you're taking we'll start breaking down the central banks. We'll start with the Fed because that's the one the market cares about the most for the most part. What do we think is going on there? When do we think they might actually get back off the sidelines? What do they need to see?
So I think every investor's it's going to take a slightly different view of the Fed reaction function. In my opinion, labor will matter most. I think if you have negative surprises, and we had a negative surprise on ADP today, but if you have a negative surprise, for example, on non-farm tomorrow, I think it increases the likelihood that the July meeting for the Fed is a live one. In other words, that they could very well cut interest rates, which is not fully priced by the market. But if we go beyond just the next meeting, right now to the end of the year, the bond market has 2 to 3 rate cuts priced into the Fed. I don't think that there's a lot of consensus around that number. And what I mean by that is I think that just kind of falling out of the distribution of how investors view what the Fed's going to do, which is either they're going to be on hold for the rest of the year or there are a lot more rate cuts that are coming. And in terms of how I would put myself in either of those camps, I think it just depends on jobs. So if jobs are weak, if they surprise to the downside, I think you're more likely to see more rate cuts than what the bond market has currently priced.
The other part of the equation for the Fed, and obviously the mandate in Canada too, is inflation.
Yes.
And I think there's been, after April 2nd, even heading up to April 2nd, all the threat of tariffs and then the big chart of the tariffs, people said inflationary. It doesn't appear to be showing up in the numbers. What's going on there?
Correct. I think up to now you've had this sort of Goldilocks outcome for the Fed. And what I mean by that is jobs numbers have been more resilient than expected by the bond market, by economists, even probably by the Fed themselves. And then inflation has been more benign or weaker than expected, exactly like you've alluded to, than the Fed has expected, economists had expected, investors had expected. So you've had this sort of very positive outcome where jobs are great and inflation's not a problem. Now we might be at that apex where it's going to go in bad directions on both fronts. What I mean by that is inflation could actually start to tick up from here, and jobs could actually fall from here, or it gets worse in the labor market. What does the Fed do in that environment? And this is where I think there are different investors that have different points of view on what would happen. I believe the Fed's going to care more about the labor weakening if it does.
How about in Canada? What's going on here? Because, of course, the Fed has a dual mandate. The Bank of Canada is just supposed to be watching inflation, but they've been sort of cautious and patient as well.
Correct. And I think in Canada, you've seen more of that tariff impact on inflation already come through versus the US, where it seems businesses and the business community is kicking the can down the road on passing tariffs through to consumers. You've seen that actually start to happen in Canada. And as a result, Bank of Canada is on pause, right? They're taking a much more cautious wait and see approach to see, is this transitory? Will it get worse from here? Will it affect more goods and services? On the flip side, we've seen manufacturing employment be really weak for several months now in Canada. That's not a surprise. We know the business community has said there's so much uncertainty around tariffs and our trade negotiations with the US. I think if we get more clarity in the next month, right? The government, our government has a self-imposed sort of deadline.
July 21st, I
that's
think,
right.
Trying to make a deal.
I was going to say the end of this month, roughly, but yes. If we get more clarity, I think there are enough green shoots in the Canadian economy that we can get through this soft patch. What I worry about is if there is going to be persistent uncertainty for Canada and for the business community. I worry that the weakness we're seeing in manufacturing could spill over to the services sector and just the broader economy, and that's obviously not going to be a good thing. Right now, from the bond market's point of view, they think Bank of Canada maybe has one more rate cut in them, or maybe they just stay on pause for the remainder of the year. And again, it depends on how things evolve from here and how much clarity we get around the nature of our economic relationship with the US going forward. But if things persist, if the uncertainty persists, I'm in the camp that Bank of Canada should cut a lot more.
Quickly, I'll ask you, that's sort of where we are and where we might be headed in the next little while. We got 6 months ahead of us now for the rest of 2025. What are you watching?
So aside from the labor market, especially in the US, although again also in Canada as it pertains to the services sector, aside from labor, what I'm watching is what business leaders are saying. And right now, a lot of the sentiment is weak for the second half of the year. I'd like to see if sort of that negative sentiment persists, or if we start seeing a rebound.